Welcome to Policy on Demand. I'm Sindhu Blume.
And I'm Scott McCandless. It is the week of December 8th, and this is your Monday briefing. Both the House and Senate will be in session this week, and with only 2 weeks left before Congress heads home for the year, they have a lot on their plate. One major item, the Senate is preparing to vote on whether to extend healthcare premium tax credits for another 3 years. Those credits expire on December 31st, and Democrats secured a promise for this vote as part of the deal that ended last month's government shutdown. Republicans may offer their own alternative plan as well.
And last week, the House Ways and Means Tax Subcommittee held a hearing on promoting U.S. global competitiveness, where Republicans pressed for progress on the OECD's side-by-side plan for Pillar 2 and warned they may revive Section 899 among growing concerns about digital services taxes. In light of this building pressure, here to discuss recent happenings at the OECD is Giorgia Maffini, Special Advisor on Tax Policy and Transfer Pricing with PwC's UK firm. Giorgia, welcome. It is great to see you.
Thank you, Sindhu. Great to be here.
So let's dive right in. As the OECD moves closer to finalizing an agreement on the Pillar 2 side-by-side, as well as the simplified ETR safe harbors, could you talk about what the key milestones are and what we can expect?
I think, Sindhu, that the most important milestone is that we are probably going to see before the end of the year, maybe a bit earlier as well, the framework that describes the side-by-side agreement, together with two other elements, the permanent safe harbor, but also we will probably understand better which tax incentives or tax credits will not create a top-up under Pillar 2. The three elements need to be addressed together, otherwise you unbalance the agreement a little bit if you address only one or two. And I think that going into that period when we expect the documents, we all have a lot of questions. The first one is, when will the agreement be implemented by the relevant countries? Will some countries be covered by the side-by-side agreement? And also, will the permanent safe harbor really be a simplification of the Pillar 2 compliance?
Compliance is the great word, and that's where we want to go next. What exactly are companies going to have to do next year? There are a variety of reporting requirements, maybe some financial interests that they have to care about. What exactly should they know?
That's right, Scott. So that's the big question for 2026. 2026 for compliance of Pillar 2 is going to be a big year, because mid-2026 for companies exposed to income inclusion rule and qualifying domestic minimum top-up taxes is the first full compliance season, really, because companies will have to submit the global information return and pay the top-up. So very important here. It might be, to simplify that a little bit, that the current safe harbor based on country-by-country reports could be extended for 1 year, but let's see whether that comes in. And probably I think two other important points for companies that will be covered by the side-by-side agreement. The first one is that if countries don't implement legislation by 2026, those companies will probably have to provide for the UTPR, for their exposure to the UTPR. You know, that means systems in place, data in place, and quite complex calculations. And then the other big question is, will companies covered by the side-by-side agreement have to comply, filling the global information return fully or maybe partially? We don't know. So I think there is a lot of trepidation around that question.
Giorgia, last month, the OECD released new guidance on cross-border remote work. What are the key takeaways for companies?
So essentially, last month, we saw an update of the Model Tax Convention, in particularly around Article 5 for those workers that work across borders, but from home or from premises that are similar to working from home, say working from a holidays home.
Right.
And I have to say that those updates give us a bit more certainty on whether a PE is a permanent establishment is established in a jurisdiction. We have seen a new quantitative threshold if the employee works for less than 50% of the time from the other jurisdiction in 12 months, then generally we would not have a permanent establishment. I'm saying generally because we are not looking at a safe harbor. And then if you go over the threshold, of course, usual facts and circumstances analysis, but to have a PE, you also have to have commercial reasons. So that increases, the threshold to have a PE. In a way, more certainty, more business-friendly result.
Giorgia, I think we'd like to end on a question about stakeholder input and what advice you would give them. One specific part of that would be with regard to the guidance you were just talking about. They're accepting input, public comment until December 22nd. So what might be your advice on that? And then more generally, what are some things that you think companies should be paying attention to?
Absolutely. So I think, Scott, in terms of the consultation, very important to raise the tax challenges that we see around cross-border remote working, not only in corporate tax, of course, but also personal income tax, social security contributions. For businesses, those are very difficult questions to solve when you have this mobility across borders of your workforce. And then I think it's also very important to bring out the economic reasons why we see now that cross-border mobility in the context of employees generally asking for that mobility, but also in the context of employers struggling to retain talent. And also a little bit because we start to hear in Europe that, for example, the European Commission in the future may need to look at limiting a little bit the mobility of cross-border workers to safeguard tax base. So very important to bring out the economic reasons of why we see so much cross-border labor mobility.
Perfect. Great advice. Thank you so much for your insights today. Very much appreciate you being with us.
Thank you, Scott.
Thank you. And a note for our viewers, in case you missed Week in Review with Rohit Kumar on Friday, it is linked in the show notes below.
There are a number of moving parts in DC right now, so stay with Policy on Demand for the latest analysis. Thank you for spending this time with us, and have a good week.